Welcome back to Market Mondays. Give it a couple minutes to let Instagram tell everyone I'm live. And for those who are joining Market Monday for the first time, this is our second series on investing. We started out talking about how to know whether a stock is a good investment or not. And what people had lots of questions about was just how to invest in general and how to better understand your investment options. So last week I walked through the investment account options available to you to start investing. And then now, once you have those accounts, what should you invest in? And that's going to be what we talk about this week. I have some prepared remarks. I'm going to try to keep these to about half an hour each week. If you have questions along the way, feel free to leave them in the comments and I will address them either as we go or at the very end. So on to this week. The question we're going to address this week is what should you invest in once you have an investment account to invest from? And I'm going to break this discussion into 2 weeks. And this week, I'm going to break it up mostly because it's a lot of information. But this week, what we're going to talk about is what the different products actually are. And it's going to be more of kind of a vocabulary lesson just to familiarize you guys with the different terms. So it's going to be talking about what is a stock, what is a bond, what is a mutual fund, what is an index fund, and things like that. Next week, week 3, we'll talk about how to choose what you invest in from those different things and from the different types and categories of things in those different asset classes based on your risk appetite. And we'll talk about what risk is and how it's defined and things like that. So that's for next week. Okay, so when you look out across the sea of investment choices out there, you are predominantly looking at allocating your investment portfolio, which is the money that you have in your investment accounts, across 3 core asset classes. Cash, which is kind of no different than like having your money sitting in a savings account, and that's what your money is in your investment account until you put it into different investments. Stocks, and we'll talk about what a stock is, and bonds, and we'll talk about what bonds are. If you can clearly understand those 3 things, it will be easier to understand all of the rest because they're basically combinations of those 3 things or investing in those things. There are also some other asset classes to be aware of, like real estate and commodities, but let's focus on the basics first. So stocks. You may also hear stocks referred to as equity. Our very first Market Monday series focused on analyzing stocks for investment, but I want to make sure that everyone is clear on exactly what stock or equity is. When a company needs money, whether it's to grow, to hire more employees, to buy another company, build a new factory, whatever, it can do so in one of 2 different ways. It can take out a loan, just like you or I would go take out a mortgage or use a credit card. Or it can issue and sell shares in the ownership of the company. This is equity, and the individual shares that they sell are called stock, and the holders of the stock are called the company's shareholders. When a company goes public, like if any of you guys follow the financial news, Uber was the big news last week. Uber went public in an IPO or an initial public offering. It's doing one of 2 different things, and sometimes it's doing both at the same time. It's either issuing new shares that are being sold to public shareholders for the very first time, or it's existing equity holders who to date have been private equity holders. They're selling the shares that they already own to public shareholders for the first time. The IPO, which stands for Initial Public Offering, might actually include both of those things. Either way, the stock is now listed and publicly traded on a market exchange every single day, minute by minute. You can see what the price is and what the company is valued at. So this time last week, a week ago on Monday, there were only a very elite few venture capitalists and private equity firms that owned stock in Uber. But today, anyone with a brokerage account can be an owner in Uber. So just to give you a little bit of perspective, the size of the equity market, so all of the stocks that are publicly traded out there, just the 5 exchanges in North America alone, there's a couple different ones in the US, there's a Canadian stock exchange, is $28 trillion, not million, not billion, trillion. And that represents 40% of the global total for almost $70 trillion globally. And just to kind of put that into perspective, US GDP is about $20 trillion annually. So the stock market and the equity market in North America is bigger than what the US produces in total every single year. So that's stock. Then there are bonds. So what are bonds? Bonds can also be considered debt. And I think everyone listening here has a general understanding of what debt is. It's basically the money that you borrow, you have to pay it back in full, and in addition, you pay interest as a fee for borrowing money in the interim. Companies, whether they're private or public, and governments, both state, local, and federal, can have debt just like you or I have debt. However, they have a few more choices about how to get it than we do. They can take out a loan from a bank, just like you or I would go and take out a mortgage or a student loan. They can have a line of credit with a bank, just like you or I might have a credit card or a home equity line of credit. They can also, however, and this is something that is not available to us as individuals, they can issue bonds that raise money from public investors, and those bonds trade in the public market just like their stock can trade in the public market. So what is a bond? A bond has a fixed face value of $1,000. It has a fixed maturity, which is the date that it is due and payable in full, and it has an interest rate. Every single bond has the same face value of $1,000. So if a company wanted to raise $300 million through issuing bonds, they would have to sell 300,000 bonds in order to raise the money they want to raise. Unlike our credit cards and our mortgages, companies don't make small amounts of principal payments when they pay their interest payment every month. So like when you pay your mortgage every month, there's a portion of that payment that is interest, and there's a portion of that payment that goes towards reducing the principal. That's not the way a bond works. The bond gets repaid in full only at the maturity date. So if a bond has a 5-year maturity, it gets taken out today in 2019, the entire $1,000 face value of the bond gets paid in 2024 at the expiration date or the maturity date. So bonds typically are issued kind of in standard increments of, it can be 2-year, 3-year, 5-year, 7, 10, 15, kind of increments like that. But it has to have a maturity of at least 1 year to be considered a bond. While they don't pay towards principal over time, bonds do make interest payments over the life of the bond. The interest payment that a bond makes is typically semi-annual, so once every 6 months, and it's called a coupon payment. The interest rate that a bond pays is going to be set based on what the investors want in exchange for holding the debt. So somebody asked, is a bond like a CD? Not exactly. So a CD is a certificate of deposit. You're basically putting a deposit into a bank and you're agreeing to lock it up for a fixed period of time. So it's a little bit different. I mean, technically deposits are a form of debt or liability for banks. But a bond is basically a loan agreement between you as an investor and the company issuing the bond. So they're not exactly the same thing. Okay, so the interest rate that a bond pays is going to be set based on what the investors buying the debt are willing to accept in exchange for holding it. And that's somewhat going to be influenced by a company's credit rating, which is issued by an independent credit rating agency. And you can think of a credit rating like a credit score, only it's on a scale of AAA to C. So just like you may have a credit rating, say your credit rating is 720 or something like that, and that will influence the interest rate that you might have to pay on your mortgage, a company's financial health is going to influence their credit rating, and that credit rating is going to influence the interest that they have to pay on their bond. The healthier you are financially, the better the company's credit rating will be, and the less interest they'll have to pay on their bonds. So when you are looking at bonds, on the public market to invest in, it'll look something like this. It'll be like Coca-Cola, which is the issuer, 3.15% November 15th, 2020. So those are Coca-Cola bonds that have an interest payment of 3.15%, and it matures or expires on November 15th, 2020. It's $1 billion issuance, so that particular bond, they issued $1 billion worth of, and they owe it in full in November of 2020. So while many people think of the stock market when it comes to investing, the truth is that the bond market is much, much larger. The global bond market has actually tripled in size over the last 15 years and exceeds $100 trillion, with 40 of that in the US alone, which again is 2x the size of US GDP. So while many of us may think, when we think of investing, we think stocks, the bond market is actually a much, much larger market. Okay, so big picture, to kind of put this in perspective that everybody can understand based on things that they're familiar with, think of your house. And if you think of your house, and let's say you bought your house for $100, that's the total value of your home. That's what you could sell the home for, regardless of how you pay for it. Let's say you put down 20%, that's your equity right here, okay? The cash you put into your home is what you own outright, and that's considered your equity, or that would be your stock if this were a publicly traded company. And you own 100% of that equity. You're the sole shareholder. The balance, the 80, to get to the total value, you funded with debt, and that would be like your mortgage. When you sell your home, your debt gets paid first, and whatever is left over would go to you as an equity holder. So if your home, for example, increases in value by 20%, and you can sell your home for $120, all of that increase in value goes to the equity, but you pay off the 80 that you owe in debt first, and there's 40 left for equity. On the flip side, if your home decreases in value, the equity loses value first, and the debt gets paid first. So the debt would get paid off, and then there's nothing left for equity. So companies work in a similar way. The same way you want to think about like the way we fund or finance our homes, companies work the same way. Their capital structure is funded through a mix of equity, or the stock that we buy, and debt. And in the case if it's publicly traded, it's stock and bonds. When you buy stock or bonds, you're buying the equity ownership or the debt of a specific company. And because debt gets paid off first in the event of a sale or a company bankruptcy, it's less risky than equity. It has a lower but more certain return in the form of the interest rate, while equity has more risk but all of the upside potential in the event that it increases in value. So I'm going to pause there for a second to see if there are any questions about stocks versus bonds. And understanding kind of what those two things are in relation to a company and risk is really important in terms of understanding the rest of these things and how they work. So if you're watching a replay later and you have questions about that, feel free to DM me or leave them here as we move forward. Okay, so those are the basic building blocks when you're looking at investments, no matter what kind of investment you're looking at. Now let's talk about funds. When you buy stocks or bonds, you are making a direct investment. So if I go, so someone said, do bonds have a lower risk than stock? And yes, in general, if you're looking at the same company and you're looking at buying their stock or buying their bonds, bonds do inherently have lower risk, and it's because they have what we call priority in the capital structure. So just like I explained with your mortgage, when you sell your house, the proceeds from that sale, by the law of your mortgage, the mortgage gets paid first, and whatever's left over, you get to keep as the equity holder. The same is true for a company. So the company bondholders get paid off first before the equity or shareholders would get paid off in the event of a bankruptcy or if the company was sold or something like that. So because of that priority, bonds have lower risk. However, debt and bonds don't have any of the upside that equity has. So it's lower risk, lower return, while equity is higher risk and the potential for higher return. Okay, So when you buy a stock or a bond, you're making a direct investment into specific company instruments. However, you can also buy funds, which may make combinations of direct investments for you. And those can be in stocks and bonds and all sorts of other things. So I'm going to talk about some of the different funds and what the different terms mean, but feel free to ask questions as I go along. So one of the things people ask about most and are probably most familiar with, and what most of you may already be invested in if you have a 401k or something like that, are mutual funds. A mutual fund pools money. So think of like a swimming pool, and you, me, and everybody listening, we all throw in $100 and it goes into a pool. They pool the money from a large group of investors, and the money manager then uses that money to buy direct investments, typically stocks or bonds. So all of us own a piece of this pool, and the value of the pool gets priced every single day based on the assets that the pool owns. And it's going to be priced at the end of every trading day, and the price of a mutual fund share is known as the net asset value, or NAV. And the NAV is calculated every single day by the value of all the underlying fund investments. So we pooled all our money together. The money manager then goes out and may buy, Coca-Cola and Amazon and Apple, and it's going to own all these different shares. And they're going to value based on the public value of all those stocks every single day in order to assess the total value of the fund. And a mutual fund can own, it could have cash, it could have commodities in it, it could have stocks, it could have bonds. And when you buy into a mutual fund, you buy at the current NAV, or net asset value. And when you buy into a mutual fund, you're buying a share of the overall portfolio or pool of assets. Just to kind of explain what a mutual fund looks like, the average mutual fund holds hundreds of different investments, giving you as an individual investor much greater diversification, meaning you can hold ownership in lots of different things as opposed to just one single name, at a much lower cost than you could ever achieve individually. When you look at mutual funds, every mutual fund should have a very clearly stated investment strategy and a benchmark. So what is a benchmark? A benchmark is basically a market index, and I'll talk about what those are in a minute, that the strategy that the manager is following is designed to either mimic, in the case of passive strategies like in index funds, or beat in the case of more active strategies. Passive strategies means there should be very low management fees. A passive strategy is basically saying, you can invest in this fund and we're going to replicate the market. And that doesn't take a lot of research or investment skill, because an index gives you a weight and it says, okay, these are the 30 stocks you should own and the weights you should own them in. So your job as a portfolio manager in that case is just managing to make sure you match the index as closely as possible. That doesn't take a lot of work or effort, and so the management fees associated with it are very small. More active strategies, where you're trying to actively beat the market and doing lots of research, you should expect, and they should carry, higher management fees. Mutual funds are managed by a money manager who earns a management fee for running the portfolio. These, along with additional administrative costs, usually range from 1% to 3% of the total funds in the pool, and that ratio is known as an expense ratio. The more assets a fund has and less active the strategy, the lower you should expect your expense ratio to be. For active strategies, you should expect your portfolio manager to beat the benchmark return after reducing the return for fees. So what do I mean by that? If you're paying someone fees in a pooled fund to beat the market, they should be beating the market and covering their fees at the same time, because otherwise they're not worth the fees that you're paying them. And just to give you kind of an indication of size, the estimated size of the mutual fund industry is $17 trillion. So, just kind of order of magnitude, We talked about the size of the equity market being 28 trillion, the size of the bond market domestically being roughly 40 trillion, and then you have mutual funds that are 17 trillion, and they're invested in both of those. Okay, so what are there questions about mutual funds? Okay, now I'm going to talk about a specific type of mutual fund called an index fund. An index fund is a mutual fund, but it's one that has a very specific and passive investment strategy. Instead of a portfolio manager actively picking stocks or specific bonds trying to beat the market, its portfolio is instead constructed to match or track a specific market index, like for example the S&P 500. Index funds are awesome portfolio holdings for individual investors like you or me who want market returns and big diversification, but without having to pay a lot of fees for it. So to be clear about what an index fund is, you need to have a good understanding of what a market index is. A market index is a basket of stocks whose performance is tracked and followed as a measure of the overall market. So I'm sure, everybody here, if you follow finance at all, you've read in the headlines where it'll say, oh, the S&P dropped 100 points today and it, was down 1.5% or something like that. That is a reflection of a market index. They take a basket of stocks with a given weighting, usually by the market cap of the company. So the larger the company, the larger the weight in the index, and they follow all of those stocks all together and they report kind of their total combined performance. Most indices, as I said, are market cap weighted. So the bigger the stock, the heavier the weight it carries in the index and the more it makes the index move. So as an example, some of the most well-known market indices, the S&P 500 represents the 500 largest American stocks. The 7 largest stocks in the S&P 500 represent almost 20% of the index. And there's 500 stocks total. So you can see how the market cap really skews the weighting of the stocks. And those kind of largest stocks in that index are Microsoft, Apple, Amazon, Facebook, Berkshire Hathaway, which is Warren Buffett's company, and Google, which has 2 stocks in the top 7 because it has 2 different classes of shares. Other indexes that you might be less familiar with but are also well known, the Russell 2000 is a small cap company index that looks at, there's a Russell 1000, which is the largest 1,000, and then the next 2,000 make up the Russell 2000. There's the MSCI World Index, which is a global market index. There's the NASDAQ, which is the 3,000 stocks listed on the NASDAQ exchange here in the US, and it tends to be more kind of tech heavy. There's the Dow 30, or that's also known as the Dow Jones Industrial Average, which represents the 30 largest cap stocks in the US. Sometimes those are also known as blue chip stocks. You might hear them referred to. And then there are bond indices too. Just like there are stock market indices, there are bond market indices that may follow, investment grade bonds or high yield bonds. You can find index funds that track any of these different indices, though the S&P 500 is the most popular. And almost every major money manager is going to have these most popular indexes. So like Vanguard, Fidelity, Schwab, they all have an S&P 500 index fund that you can invest in. When you invest in an index fund, your fund return should track your benchmark almost exactly. And just to give you kind of why you should care about index funds, over the last 5 years, the S&P 500 beat 82% of actively managed large cap funds. So why would you pay a manager to manage money for you on an active basis when they can't generate a return as good as the index? And you could invest in an index fund for less fees and ultimately higher performance. So that's kind of the argument for index funds. Okay, another fund that people, and let me pause for a second. Are there questions about index funds or how an index fund works? Okay, so on to exchange traded funds. You might have heard of an ETF. That stands for exchange traded fund. An ETF works a lot like a mutual fund with one key exception. If you remember when I first talked about the mutual fund, a mutual fund is priced daily at the end of every day, and that price is called the NAV. An exchange traded fund is actually traded all day long on an exchange. So you can get a price of an ETF every moment of every day, just like you could with a regular stock. Whereas a mutual fund, you kind of buy in at the end of every day, and the NAV only changes once a day. Many ETFs are index ETFs that work like an index fund. So why would you use an ETF over a mutual fund? ETFs are kind of these pooled, they're also pooled investments, and then the different shares are what are publicly traded on exchanges. And the cool thing about ETFs is they typically have lower investment minimums than a mutual fund. So as an example, you can buy a share of an ETF for maybe $100, whereas to buy a share of a mutual fund might be $1,000 or more. And then you also have the benefit of real-time pricing all day, every day. And the estimated size of the ETF market is $3 trillion. So it's a lot smaller than the mutual fund market, but it's mostly because it's a newer market, but it's growing very, very rapidly. Okay, so that kind of explains mutual funds, index funds, and ETFs and how they're similar and how they're different. Let's talk about some of the other asset classes and investment options out there. There's real estate. I think people kind of have a general sense of what real estate is. It's owning property. And you can buy properties yourself for investment, things like rental homes, vacation properties, or there's actually publicly traded entities called REITs, which stand for Real Estate Investment Trust, REIT. To qualify as a REIT, there are specific rules that a company has to follow by the IRS, one of which is that most of the assets have to be invested in real estate. Most of the income generated has to come from real estate, either via rent or sometimes they issue mortgages and the payments they're collecting on the mortgages, or from the sale of the real estate that they own. And then all that they bring in, 90% of their taxable income has to get paid out every year as dividends. So REITs tend to be very, high yield dividend paying stocks. There are more than 200 publicly traded REITs in the US. So there's a lot to choose from, but like most stocks, you need to kind of understand what you own and understand the quality of the assets that a REIT owns. The other thing to caution about REITs is they have high management fees layered into kind of the construct of the company, but it can give you steady dividends and it can give you kind of real estate exposure and diversification without buying and actively managing properties yourself. So that's kind of a quick rundown on REITs. Another asset class that you may have heard of is commodities. So what is a commodity? A commodity is a basic good that looks the same no matter who makes it. So what might qualify as a commodity? Things like oil, or a farmer who grows a specific kind of corn, or soybeans, or precious metals like gold, even meat like beef, and other energy sources like natural gas. But basically think of it as things like crops, metals, and energy. And commodities are also publicly traded. And to be traded on a commodities exchange, they have kind of certain standards and specifications that they have to meet. So it'll be a certain grade of gasoline, as an example, or a specific type of corn. And in recent years, commodities exchanges have expanded to include all sorts of things like financial products like currencies, and indexes too. And there's even now like technology commodities that are traded, so things like cell phone minutes and bandwidth, which is kind of crazy. And somebody asked if I'm going to save this. I'm going to save this. The replay will be up for 24 hours, and then I also download these, kind of edit them, and eventually upload them to YouTube and in blog posts. So this will continue to exist if you can't catch the whole thing now. Most individual investors get exposure to commodities through mutual funds that they're invested in, because to actually buy and sell commodities requires using what are called futures contracts. And a futures contract originally was created to basically give some insurance to the producer as well as to the end user. And so what would happen is you might have this huge farmer in the Midwest who grows corn, as an example, and he sells his crop to someone like General Mills, like a cereal producer. And in order to lock it, like, it costs a lot of money to raise the crop, and to kind of de-risk that cost, he'll sell a futures contract guaranteeing that he can deliver a certain number of bushels at a certain price to the end producer. And that's kind of what a futures contract is. But here's the thing. If you're a speculative investor and you're buying and selling futures contracts, if you hold a futures contract to expiration, you'll actually have to take delivery of like 5,000 bushels of corn, which most people don't want to do. Share my YouTube channel when I can. I will. It's very young and just getting started, but I'll actually, if you go to the link in my bio and scroll down to the bottom, there are links to all my different social accounts, so you can find it there. Okay. So like I said, these futures contracts for trading commodities, which is essentially how commodities are traded, were originally created for the good producers and the good buyers. And they sold these contracts stipulating the price and quantity to a buyer who actually needed the products for whatever that they were making. And I already kind of gave you guys the example of a corn farmer selling to General Mills. And it was a win-win because they both get price certainty, both for the producer and for General Mills as their cost input. They get certainty around that. But now there are market speculators who trade in futures just to capitalize on the volatility and the price movements in the market, which, so those are commodities. Another asset class that I get asked about, or investment option, is there's a large group called, we'll call them derivatives. And these are a little bit more complicated. So before defining exactly what a derivative is, I want to give you kind of an analogy that most people might better understand to help make it more tangible. So let's say you go to the Kentucky Derby. There are thousands of people, both at the race itself and electronically all over the world, who are betting on what horse they think is going to win the Derby. They can bet it as little as $1 or as much as thousands of dollars on whatever they think will happen. Then at the Derby, there are also the actual owners of the horses. And to buy and raise a horse to have in the Derby costs hundreds of thousands of dollars. So you have these people who can make small side bets for far less money than the people who own the horses themselves for a whole lot of money. Think of all the little people making side bets in small amounts as derivatives. Those side bets are the derivatives, and those are by speculative investors. The horse owners, they're like the stockholders with actual equity ownership. At the end of the race, the winning horse may win $2 million for its owner, who can then likely sell that winning horse for millions more for breeding and things like that. The side bets market, in 2018, there were 150 million in wagers on the Kentucky Derby, all hoping to turn their $1 bets into $100 of winnings. So you have this derivatives market, just using the Derby as an example, that's 100 times the size of the underlying market. So the pot for the Kentucky Derby, for the actual horses running the race, is only like $2 million, but you have hundreds of millions of side bets on the side. And that's kind of how you should think of the derivatives market. So what is a derivative exactly? It's a financial instrument whose value is determined based on an underlying asset or group of assets. So in the case of like the Kentucky Derby, all those side bets, they don't have any claim of ownership on the horse that wins. However, the outcome of their bet is determined on whether or not their horse wins. So the horse is the underlying asset, and their bets are the derivative or the side bet. So what are some examples of derivatives outside of horse racing? As an example, you might have heard of stock options. An option is the right to buy, known as a call, or sell, known as a put, a stock at a given price at a specific price through a given point in time. So it may be something like, say, and I'm making up numbers here, say that a stock currently trades at $100. I may buy an option to sell the stock at $110 in the next 3 months. And in order to have that right, I'm going to pay a small premium for it. And then once I pay that premium and own that option is tradable too. And I can keep it and choose to exercise it at any point from now until it expires. And when it expires, that right goes away and it's worth nothing. Other examples are futures, and we talked a little bit about futures and commodities, but there are also futures on things like currencies. Other derivatives are things called swaps on interest rates. So there's lots of different derivatives out there, and generally speaking, as a retail investor, you probably won't use them that much. However, it's important to be aware of them, and for this primary reason. The size of all these side bets out there on the market, it's hard to know exactly how big it is because there are exchange-traded derivatives, but then there's also what we call over-the-counter ones. And over-the-counter ones are ones where, like, I may just pick up the phone and call my friend Sue down the street and say, hey, can I make this deal with you? It wouldn't necessarily be with your friend down the street, but it might be with a bank as opposed to like over an exchange. And those over-the-counter derivatives are far less regulated. But it's estimated, and remember how we talked about the size of the equity and commodity markets and mutual funds and bond markets in terms of trillions? The derivatives market is estimated to be as large as 1.2 quadrillion. So multiples the size of the stock and the bond markets. And that can be very scary, mostly because you don't know who all the holders are and who all the players are. And we won't get into it today, but if you think back to the big market crash in 2008, derivatives played a very large part in that. So the size of the derivatives market and all these side bets being made in and around the market is kind of a scary thing, and it's important to understand that that's out there. Okay, so I'm going to pause for a second. I've exceeded my 30 minutes, and that was a lot of information, but I hope it gives you guys some more clarity on the choices available to you from your investment accounts. And also how, when you think of investing and you're only thinking of stocks, that's really only the tip of the iceberg in terms of what's out there. Okay, so if there are questions, feel free to leave those. You're very welcome. And we'll pick up here next week and talk about annuities, which somebody asked about and I didn't get to yet since we were running out of time. And then we'll also talk about understanding how people asked a little bit about what's risky and what's more risky or less risky. We'll talk more about understanding risk and return next week. And also how to get a sense of your personal risk appetite. Everybody has different comfort levels when it comes to risk and taking risk. So you need to understand the way you feel about it, the way the market and investment world measures it, and then decide what products make sense for you based on those two things. And specifically, we'll talk about what does it actually mean to be a conservative, a moderate, or an aggressive investor, which is how you'll see sometimes mutual funds and the options in your 401k described. If there's something about investing that you'd like me to talk about on an upcoming Market Monday and it doesn't fall into the areas that I've outlined or coming up, please feel free to DM me or leave a comment here and I'll try to work it into the discussion. As I mentioned before, this replay will be up for the next 24 hours. Fingers crossed that Instagram is cooperating today and it lets me do that. And I'll also download it and throw it up on the YouTube channel. If you're looking for my YouTube channel, you can find it in the link in my bio, or if you go to familyfinancemom.com, you can find all my social accounts linked up there as well. And then what I try to do is I download these, I edit them, I add some of the graphics and things that I showed into it, I upload it on YouTube, I embed it in a blog post along with all my summary comments. People like to learn in different ways, so I try to kind of do it in all different formats. Have you mentioned what the next book we will be reading? I haven't yet. We still have 2 more weeks in May, and so there will be 2 more posts in my feed in the coming weeks that talk still about Rich Dad, Poor Dad. Just as a teaser, this week I'll have one where people can ask questions. If there were elements of the book they didn't understand, they can ask those questions on that post, so that'll be coming this week. And then I'll announce the book for the next 3 months at the beginning of June. And keep an eye on my stories because I'm having some trouble deciding on what book I want to do, so I may do a poll to get people's feedback to see what they might be interested in. So thank you guys all for joining. Thank you for your questions. And as always, if you have other ones, feel free to DM me anytime. And I hope you guys have a great week.